You might have wanted to be confidential before, but now you're going to have to give more. In fact, you might give more to regulators who can come and see something that's not correct and could potentially give you a fine or penalty until you get it done. If there's any sort of outstanding litigation ongoing, you'll need to disclose that.
You're listening to the Global Workforce Podcast with me, George Britton. Each week, we interview an industry expert to dive deeper into the world of managing a global workforce and discuss the big strategic challenges that you're going to encounter along the way. This episode is brought to you by Omnipresent, the global employment platform that allows you to employ anyone, anywhere without having to set up an entity. Designed, built, and supported by global employment experts, Omnipresent takes care of your international employees and contractors, so you don't have to worry about payroll, HR, or compliance issues, making it easier, faster, and safer to expand internationally. I'm delighted to be joined today by an expert in corporate finance and capital market transactions, with extensive experience across multiple sectors, including energy, healthcare, and technology. Michael Blankenship's expertise spans IPOs, M&A, and SPACs, where he's advised both issuers and underwriters in the US and in international markets. As well as being the managing partner of Winston's Houston office, Michael is co-chair of the firm's capital markets practice and a member of its executive committee. His work regularly involves in advising public companies on strategic transactions, corporate governance, and securities in market regulation. Michael is a trusted advisor to clients across diverse industries, and he frequently provides insights into the evolving landscape of corporate finance and capital markets. Michael, welcome to the Global Workforce Podcast.
Thanks, George. Great to be here. Appreciate it.
Fantastic. Well, I feel privileged to have you here, Michael, but let me jump straight in. I'd love to kind of get a bit more about you, your background, your career. Your career has been very impressive to date, and it spans multiple sectors. Can you start by sharing a bit about how you got into this field and what led you to focus on M&A and IPOs?
Yeah, I think if we go back to when I was studying in college, I always wanted to be an economics, finance person. I went to business school. I mean, MBA, went to law school. So I always knew on the legal side, I wanted to do the corporate side of things, so the transactions. And so that got me into the legal field. And I started my career in New York, where it's, financial center, doing all different types of work, spanning from working with bulge bracket banks to working on various M&A transactions, and just getting a good sense of how the market is dynamic, how you have, all the different players. And so that was always of interest to me. I always liked the stock market, for instance. So like doing IPOs, helping companies go public, to get on the stock market, whether it be New York Stock Exchange, NASDAQ. And in fact, working on cross-border transactions as well was always kind of fun because you learn a lot. And so that's sort of how I got into the field. And then I've kind of moved since and doing a lot more, helping clients even more on the board level. When you're sort of a baby associate, you're not doing that, you're learning the diligence. But from that, I built a good practice and built a lot of good relationships and network.
Awesome. And did you see a big change when you moved out of New York and you moved to Texas? Like, how do you see do you see different kind of level of pace with transactions? What's your take on that?
Yeah, I think the pace is about the same. In Texas, there has been a lot of growth in the corporate sector from various industries, from energy to healthcare, technology. If you look at Austin, Texas, and they're all capital intensive businesses, which means they need corporate lawyers to help do the transactions, do the documentation, do the diligence. And so we've, I've seen a lot of the same sort of pace. I will say in New York, it was great training for me, and maybe that's how I've seen it, where I've worked on fast pace, fast speaking folks to get transactions done. But you do the same late night hours as it needed to get a deal done. But there's a good business environment down here as well.
Yeah, good to hear. So I'm curious to get your take on like the shifts in the IPO landscape. It seems to have evolved significantly over the past decade. On a recent podcast, I was looking at how the UK IPO landscape is changing with some of the regulations they're bringing in. But I'm curious to get your perspective on kind of the US IPO world. What are the changes that you've seen across different countries and across the sectors that you focus in?
Yeah, I would say in the last decade here, and I'll start with the US and I'll go across, across Europe and other in Asia as well. Here in the United States, starting about a little more than a decade ago, they put the Jobs Act into place. So they were trying to help emerging companies be able to go public a lot easier, reduce that regulatory cost and burden. So we saw a lot, usually 250 IPOs up until about 2020. And then there was a spike where we saw go all the way up to over 1,000 IPOs, and now we've kind of in the last 3 years just seen a steady state of about 150. I mean, 152 last year or so. This year we're kind of on pace for about 170. We have an election, so there's some slowness in that, but I'd say it's about 170. So a lot of the regulatory issues still remain. They're still very costly to have the public company overhang. You really do it to go public. You're trying to democratize, I guess, the ownership as well as get an ability to do an acquisition through equity, do have an ability to raise money a lot easier because you have the public market. So I think you've got those kind of headwinds with regulatory, which has caused a little bit of slowdown. If there's, we've seen some movement where they're trying to do it, but we're starting to see a lot of smaller IPOs. It didn't help that in the US, the tech sector kind of fell off and it's been, the valuations fell off. So it's not as much, but we have seen in the US movement of companies that have IPO'd. So their stock has gone up and it's shown that there is some support for those. Turning to the UK, from there, we've seen some on, the London Stock Exchange as well as other exchanges there where we're working on it. You often will even see guys come here in the US to try to market to go to their exchange. I do think, the regulatory risk remain the same. In Europe, when you do the NYSE Euronext, you have a lot more sort of diligence up front from, the regulators as well as the banks trying to do it. Here in the US, it's not the same. We don't have like you don't have to go the full amount of it, whereas you would in Europe on the regulatory basis. And then in Asia, if you look at some of the markets, they actually don't have right of private action. So that just means a lot of diligence has to be spotted and done well ahead of the listing, which puts a lot of more work on the front end. So any statement made in the registration statement, or whatever form is needed to get listed, it has to be diligenced, has to be backed up. We have a process here in the US where we do that with diligence, under certain rules and requirements and opinions that counsel give and auditors give their comfort letter. But it's not the exact same where you have certain exchanges and regulatory bodies requiring that upfront diligence to make sure every single statement has support. So yeah, I think the biggest thing there is making sure if you're going to list that you understand the regulatory environment and regime, because that can make a difference on how you do it, especially when it comes to financials. Make sure those are in check and done correctly, as well as understanding the listing requirements on the particular exchange and the governing exchange commission.
So a couple of things you mentioned there I thought were really interesting and worth touching on a bit more detail. You talked a bit about the tech sector being affected in the last few years and that slowing down, but also the election coming up and that guessing, do you have any hunches on what might be happening post-election?
Yeah, look, post-election in the US, we typically actually see an uptick in transactions and deals following year. And that, partly because all that uncertainty has come to head and anyone that wants to do a deal, it will take Congress and Senate here in the US, as well as the president to do any kind of transaction or bill or anything that will make them, slow things down. So that uncertainty has kind of gone away at that point because, hopefully, where the results are by that point. So I think post that, you'll see some of that. On the tech side, valuations were cut in half. People were looking at, the same values, 50% less. But we are seeing a number of tech companies wanting to go out there. We have seen the AI come in as the hot thing, the chip makers, following anyone that services the AI industry. We're starting to see that now. We've seen with Amazon's note on the nuclear, we're seeing nuclear go up. So a lot of that uh, will post election will happen. It's just a matter of where we see that kind of going forward. Right now, I don't know that there's a particular thing that will happen either way of the results.
Mm. Yeah, understood. I think it's quite interesting how much can things can sway based on these kind of events. I was speaking to somebody a few months ago in the green tech sector, and this was back before Harris joined the. It was still Biden versus Trump, and then based on that debate, they were like, "Look, we're going to actually dampen our hiring plans because we don't think that this is going to go our way in the green tech sector." So it's amazing how just these singular events seem to change so
Yeah,
much.
and to that point on the green side of things, the energy tech, there was a lot of money during the pandemic. We saw, the IRA, Inflation Reduction Act, provide for a lot of that money from the government. But we haven't seen the returns on the energy tech sector. In fact, you normally see an inverse proportion between technology and energy. So energy's up, tech's down. We're seeing that now. So I don't know, it's just a lot of companies kind of pushed into that sector. It's just, I don't, to your point, I don't know that the money's going to be there. There's an appetite for that. So we kind of went off, kind of like the tech sector. Everyone thought doing all of what we're doing on technology, Zoom, and other areas were going to be like it, but things kind of went back to the normalization where it was pre-pandemic.
Yeah, yeah, yeah. Because of course you've got lots of experience across energy, infrastructure, and healthcare as well. Can you talk a bit about some of the sector specific challenges that you see for companies going to IPO or to go through other liquidity type events?
Yeah, energy, they're on traditional energy. So if you talk about oil and gas, you talk about the subsectors of upstream, midstream, field services. Those have, there's been not as much money and there's been a pullback on both raising from the private equity, which typically where a lot of the money comes. And then you've seen commercial banks pull out their portfolios or sell the portfolios. So that means there's the lending that isn't there. So private credit's kind of filling that void. Anyone that wants to do an IPO or liquidity event, it's a little bit more difficult because the appetite hasn't been there. Now, that said, there have been a couple of recent energy ones that have filed to go public. And we're starting to see that percolate. So there are some liquidity events there. We're also seeing continuation vehicles in the private equity side. So those are continuing to push into the energy as well. So they continue the life of that portfolio company before it can potentially go public. So there is some appetite to do that, to do an IPO. I do think that there are a number of ones that will. I will say the pipeline companies, so if you look at the midstream, there aren't as many because when we had master limited partnerships and the tax rates here were higher in the US, there was a better return and they could do that. But MLPs have fallen off favor for a while. So you probably won't see many midstream ones. On the healthcare side, those are ones that will always want to go public because those are probably the most capital intensive, especially the biotech ones. So we see a number of the biotech, here in the U.S., out of California or other areas globally that will need to raise money to do get the regulatory approval through the FDA here in the U.S. or the similar group in Europe or Asia. And so we have always see that those companies are wanting to go public. Now, if you've got a good drug, if, for instance, in the diabetes area, where we're seeing an aging population, and we'll need more healthcare needs. So there are companies trying to fill that void and help in that sector. So they'll need cash to do that. So they will go public. Those are ones that will do that. How successful it'll be will depend on how quickly they get regulatory approval, what kind of product they're doing. But yeah, I think there's certainly those will continue to try to go public.
Yeah, understood. Now, Michael, you've got a lot of experience in both US and non-US capital market transactions, and you touched on this a little bit earlier about Asia Pacific and some of the other transactions you've been working on. When it comes to the regulatory requirements, what are the key things that people need to be aware of from a regulatory standpoint? What should companies going through like an M&A or IPO like be thinking about before they start?
Yeah, I think the biggest thing is to understand the consents that are required. If it's an industry that has a requirement of a regulatory body to consent, they'll need to know that. You'll need to know all the requirements to list if they're going to list somewhere. So if they're an IPO, so you'll need to know what that exchange requirement is. Those are the biggest areas where sometimes there's a footfall because they didn't get the proper consent or it takes longer to get it done. If it's an area that touches a lot of consumers or individuals, like healthcare, there's a lot more approvals and requirements, and then confidentiality around that. If it's in the tech sector, may not be as much, but it is about disclosures and how you run your business. If you do an IPO, remember you're giving as a full view of your business to folks. So you might have wanted to be confidential before, but now you're going to have to give more. In fact, you might give more to regulators who can come and see something that's not correct and could potentially give you a fine or penalty until you get it done. If there's any sort of outstanding litigation ongoing, you'll need to disclose that. So all of these are important to understand whether or not you're in the US or outside the US. You need to make sure you understand where your company stands with all of those potential issues because you are going to have a diligence process, whether it's an M&A or an IPO, that's going to flush out a lot of this. And so you have to make sure you have all your, your books and records in order for both the regulator and counselor or the bank that's going to help you get there.
Got you. And are there any common pitfalls that you see with companies looking to go through these processes? You mentioned regulation, getting proper consent for healthcare sectors. Are there any kind of common things that people overlook?
Yeah, I think the sometimes they'll overlook certain regulators. They'll know if they know their business, they'll know to go after them, but they may not know their business enough to know what a regulator and a exchange or exchange commission, securities commission would want to know. And sometimes those are footballs. You talk about human, resources, HR. Those are issues too. You need to make sure you understand when you're doing employment plans, executive compensation, what that looks like, because you'll have both shareholders that care as well as regulators. So those are always important to keep in mind as well. Sometimes they are thinking about the people who work for them, but that's a critical piece too. That could be a pitfall if they don't have it right ahead of time.
Got it. Um, Now, Michael, you've worked on some very complex and high stakes deals, in particular in the energy sector. I'm curious to get your experience and your take on some of the most common challenges that happen in some of those larger, more complex deals.
Yeah, so those deals will typically have a financing issue or a potential issue to have to, how do they pay off the debt if you're going to acquire a business? They're going to have certain, if it depending on the kind of subsector, kind of regulation. So you might have some in the U.S. state regulations that matter. You're going to have many parties that have a piece. So whether it's a landlord type situation or there's a lease involved, you're gonna have right of way issues, easement issues. So all of those kind of real property matters come up because you are in the energy sector taking something from the dirt. So people do own that, and you need to understand. And then you've got on the regulatory body, whether it's here in onshore in the US, you have, and it depends if it's in federal land or state land that you're doing. You've got, if it's offshore, you've got offshore water commission folks that are going to, the Bureau of Ocean, that are going to matter. If it's outside the US, if it's in the North Sea or Aberdeen, you're going to have to deal with UK requirements as well. And so you've got a whole list of requirements depending on where operations are that take time and put it into place. Now, depending on how the capitalization structure, the cap structure is in business, you're going to have to structure the transaction as well. Who's acquiring, how it's being acquired, what parties do you need certain merger subs and other kind of businesses to get it done, and what do their subsidiaries look like? You need to understand all of their subsidiaries and get a good feel for whether or not there are any issues in the subsidiaries. Are you going to take those subsidiaries with you, or are you going to carve them out? Are there big litigation going on? Are you going to carve that litigation? Who's taking liabilities for certain things post close. So those are all kind of issues that you have to think about as you do these more complex transactions. And not to mention the biggest is probably tax. Tax affects transaction a lot, and how you want, if it's a tax-free reorg, tax-free acquisition, you want to make sure you're doing it right. Just depends on what the investor base is. So there are a lot of issues here. I could go on for a while, but I think being mindful of that is important.
So yeah, so Michael, you've mentioned a few different things there. I guess each of these elements could be unpacked and become complex depending on the deal, right? You mentioned things like financing issues. You mentioned things like cap structures. You mentioned, subsidiaries, and when those subsidiaries they operate in different countries, like in Aberdeen, like all of a sudden the complexity increases, right? And then you've got the state regulation. I guess you've got federal regulation as well. You've got offshore versus onshore, plus all the tax stuff. So these can see that these deals can get incredibly complex incredibly quickly, right? Um, do you typically operate on these deals kind of um, like solely as one firm, or do you normally get multiple firms into to work on
Ye-
these things?
Yeah, great question. If it's outside the U.S., we'll have multiple local counsel, as we call them. So if it's, if there's in the Middle East, if there's something out there, we'll have counsel, local counsel. If it's outside our jurisdiction where we can do something, then we'll have local counsel. If there's property issue in, say, the state of Oklahoma, we'll actually get help there. But for the most part, if it's within the United States, we can provide legal cover for that, especially if it's security side, because securities in the U.S. is federal, so all states involved. If it's a particular area in the U.S. where we have an office, we can operate there too. So yeah, to answer your question, we do get local counsel as needed.
And then we've talked a little bit about the energy sector there and those different elements. And then when it comes to like the workforce and a compliance perspective, you mentioned, all of these deals, they're going to have a diligence process. So make sure you're ready for that. Are there any things that you tend to advise clients on from like to prep for those diligence processes that might be sector specific at all?
Yeah, great question. We do often tell we have a diligence request list that it's tailored to their business. So if it's healthcare, depending on the sector and life science, healthcare, are there approvals? What do those look like? What are their products? Kind of flesh that out. Government investigations, anything. Whereas if it's sort of on the tech sector or energy, it'll have different questions there. So we'll prep them with that, and then we'll help them put their data room together. So the data room, virtual data room, is important because they'll put all of their documentation and anything that could come up. And then the other side. So if we're buy side, that's what we'll put together a list to ask the seller. If we're sell side, we'll help our client. To your point or your question, get them in good shape for that transaction.
Yeah, makes total sense. I guess one of the things we're kind of touching on here is the cross-border challenges, right? So you've got a, say, US company, you know, acquiring um, or making an asset purchase with a foreign company, a multinational company. In terms of like a workforce compliance perspective, are there common things that you that come up in those situations? You've got different labor laws in different countries. Um, if you're acquiring a French company or a French workforce versus a UK company, UK workforce versus Singapore, all of these have local nuances, right? So, um, how do you think about helping clients to navigate some of those situations?
Yeah, that is a big issue that comes up on cross border transactions where we're helping um, navigate the diligence around that. If we're the buy side, understanding the labor laws there, what it looks like from an employment standpoint, having to take on the employees, what kind of notices you have to give, employment contracts, what do those look like if you're, onboarding those employees to your plans, to your business. Um, that is something we have to navigate every time we do a deal. I mean, we're had a call this morning about a transaction cross border. It's in the UK, and that is one issue that came up as well. So it is one that's critical to make sure you understand the labor laws that are local to that country, because each one may be more stringent than the other. And one thing you may do in your home country may be different than that home country. And so it might be stricter to it. And so you need to be to the most strict regulation there.
Yeah, makes total sense. Um, just switching lanes a little bit from M&A to IPOs. Do you see any differences in terms of the compliance issues that come up between those different types of transactions? Do you, the things that you would look for in an IPO that are different to, let's say, an M&A transaction, or do you see them being pretty similar in terms of a diligence process?
Well, they are different. You do have securities diligence because you're putting disclosure out onto a document. So you need to make sure that there's nothing materially misstated or omitted from that document that you're putting out to the public, which is a little different than the M&A. Both, of course, have make sure that there's nothing there that's wrong or not asked for. But from an IPO standpoint, you need to have all that information because you have a regulatory body asking questions. You have counsel on both ends of the transaction. So you have counsel to the issuer, you have counsel to the underwriter, and then you have auditors looking at the financials who are going to give comfort on the financial statements to the underwriters. So you've got a number of parties. For example, in the U.S., you've got all these counterparties. So you've got the SEC, that are the Securities Exchange Commission. You have FINRA, which is the financial body, the self-regulatory organization over the underwriters. You've got issuer, you've got its counsel, and then you've got underwriter and its counsel. So you're talking about six parties where an M&A won't have that, but you do have diligence, and they're always or should be counsel bake in if you're a buyer, sort of indemnifications if it's a private sale or some way of if there's an issue posed that wasn't picked up in diligence properly because it maybe not have asked the right question and he shifted that risk allocation to the seller, then you've got ways to do that. And an IPO, that's not the way it works. It's underwriters have to have all the information fully disclosed, fully vetted, and before they can go out and sell to investors.
Got it. So is it, am I right in thinking basically the underlying fundamentals are the same? Like you want to protect your IP rights, you want to make sure that you understand everything that's going on with every single worker, classification, things like that. Difference is when you get some IPO, you've got like extra sets of eyeballs going, like looking at these things and extra people that need to report on it. Or is that fair, or have I misunderstood?
I mean, that's fair. You have different parties that have interest in it, depending on, the transaction, but that's a fair assessment.
Okay, cool. I wanted to switch now to SPACs and special purpose acquisition companies. You've written about these recently, and there's some new regulations surrounding these in the US. I'm curious to get a take on this and how they're shaping the wider market from your perspective.
Yeah, I think, if you go back 4 years ago, you saw 300, 400, almost 600 of them out there. They were quite quick and easy to put together. Now you've got more seasoned sponsor teams doing SPACs. The regulations that the SEC put out were initially out in 2022. They weren't adopted and effective until July 1 of this year, 2024. And so you look at 2 years of companies, underwriters, any party ready to answer and disclose the SEC's requirements. Um, I don't think they've been a heavy lift because they've been used to it. Some of the things the SEC was weren't adopted, and so that makes it a lot easier on the transaction to get it done. So now you're going to probably see 40 to 50 SPACs a year, as opposed to 600 that half of them would be liquidated at this point because their life span ran out. And so now you've got uh, way more sophisticated, and it's kind of gone to a center that's reasonable.
Got it. And when you come to looking at SPACs, how does that shape or alter like the diligence process when you're going through an IPO? What does it mean for like public company readiness? What's your perspective on that?
Yeah. So the diligence is going to be around who the sponsor team is, the directors and officers, kind of understanding that, making sure that because what they're disclosing is their history. And so you have to make sure when you do those questionnaires with them, you understand what their history is and that's correct. You do background checks on them, you make sure that there are no issues there. And then it's really disclosing what they're looking for as a scope. But again, the SPAC doesn't have to be wedded to that particular area, but they do tend to be if it's an area where the background of the sponsors are. So, for instance, if they're healthcare related, you're going to have healthcare related businesses are going to go after. If it's, folks looking in Asia, those, typically ones that have a background there. And so that it just depends. And that's the diligence you're kind of doing early on because they're not established businesses. They're new businesses that put the money into trust. So they don't get the money, but they have a working capital to go find a business.
Yeah, it makes a lot of sense. Perfect. Last question for me. I just want to focus a little bit on employee diligence. Like one of the things that we often look at when we sometimes get brought into some of these transactions is classification of employees. Sometimes people are misclassified as contractors when they are actually economically dependent on the company, and even if they're in a foreign location, they're making sure you have they're paying the right employer costs, the right taxes, and following labour laws is one of the things that we come into to kind of support with. Um, but with your your perspective on these things and workforce diligence, are there things that you tend to look out for? What do you typically kind of highlight for global companies when they're looking at employee diligence?
Yeah, and that's a great point because that's the one area where we see a lot of lawsuits because the misclassification between a independent contractor and a salaried or hourly employee. I think we'll often ask the question, what does their workforce look like? Do they have salary employees, hourly employees, and then how do they define what an independent contractor is for them? So they are sending here in the U.S., a 1099 or the equivalent outside the U.S. How do they define those independent contractors if they do have them? Because here in the U.S., courts have put together sort of what it looks like to be an independent contractor versus uh, an employee of the company that should be withholding taxes and doing all their offering plans and other requirements to be an employee of a company. And so it is something that is of particular interest because it's very costly if it's wrong, because you're going to see class, class action lawsuits that companies will see from plaintiff law firms. And we'll try to change and say you misclassified, we owe us X amount of dollars. And you want to know what that looks like early on in your diligence process.
100%. Michael, it's been great speaking to you today. I feel like I've learned a lot on lots of different topics here. Final question: what would be your key takeaways for any company that's prepping for IPO or an M&A with a global workforce?
Yeah, I think it's get your diligence in order. So your data room, make sure you kind of understand and that you're going to wear a different hat. So you're not going to be operating the same, like you're trying, if you're doing an IPO, you're going to have an IPO hat as well as running a business. M&A, the same thing. You're going to have a limited scope of people kind of helping out, especially if you want to keep it kind of confidential and not tell employees. Uh, I think understanding the regulatory requirements in various countries, if you are acquiring businesses with a number of employees and what that looks like. And then I think lastly, you're getting a business that has employees, but what kind of industry is it in? And are there other regulatory requirements if you are trying to buy that business? What do those consents look like? And then an IPO, what does the exchange require on disclosure of those plans? Because in the US, I know we've got a number of requirements that you have to disclose employment information, especially for your executives. So those are all kind of key things to keep in mind as you're trying to get a transaction done.
Makes total sense. Fantastic. Michael, thank you so much for being my guest on the podcast today. I've learned a huge amount. And yeah, really looking forward to seeing things take off in future.
Great. Thanks for having me.